Hi, everybody. Thank you for taking the time to join us today for this webinar. Today, we are proud to launch our essential new report, The Sustainable Finance Revolution. In this new paper, Positive Luxury explores the impact this revolution will have on your organization and explain the key actions your business can take now. We'll cover this topic further in today's webinar with Positive Luxury's co-founder and CEO Diana Verde Nieto, Tony Burdon, CEO of Make My Monumental, and Lapo Favilli, ESG operating partner at Blue Gem Capital. Before we start, I want to remind you that this webinar will be 45 minutes, including 15 minutes of Q&A at the end. You can submit your questions anytime during the webinar through the Q&A box. Over to you, Diana.
Good afternoon, everybody. Well, I mean, this year has been a year of economic shock and transformation. It's been a year where ESG has been at the forefront, and it's been an imperative now for companies to tackle greenwashing. And not just that, also just to put social equity at the fore. I'm sure you have probably heard about net zero. Net zero is at the tipping point as economies and capital markets finally understand the relationship between company actions and carbon emissions. Diversity and inclusion, it's also something in the S factor of the ESG that is coming very slowly into the boardrooms, but when they get there, are smashing doors. Climate finance investment flow continues to rise, but far from below the levels that actually it should be. But there is good news. The good news is that sustainability can lead to economic recovery, and the investment in sustainability can actually be pivotal for actually human race, really. So I'd like to start with Lapo. Thank you so much for taking the time to do our webinar today. So Lapo, can you explain what is ESG?
Hi, and thanks for having me. Well, ESG stands for environmental, social, and governance. And in finance, in particular, ESG has come to signify a philosophy, if you will, that environmental and social considerations and governance are relevant factors in investments decision-making. Investors that follow this philosophy, like Blue Gem, are sometimes called responsible investors. As responsible investors, we believe that it is both financially and ethically irresponsible not to consider the environmental impact of a company when assessing its merits as a potential investment for you. We can contrast this with, how historically many investors have seen environmental and social impacts just like negative externalities that could simply be ignored when looking at, investment decisions. So, in a nutshell, that's it, Diana.
So, how do you prospect the companies that you will invest through this lens? How do you do that? What is the process? If you can explain that to us. Thank you.
Sure. So when we look at a potential investment opportunity, we use ESG factors. So step back. We have integrated ESG considerations in all phases of our investment process. And as a result of that, when we look at investment opportunity, we use these factors to assess emerging potential or envisageable risks and opportunities. We may, for example, just to make it more real by giving an example, we may consider the opportunities that are brought about by legislations that are being considered on pollution. Or we could try to estimate and consider the risks to the operations of a company that we're looking at that are linked to climate change, which is extremely easy to figure out these days. What we do is we assess these factors and we adapt our valuation models accordingly. So we reflect these considerations eventually in the price that we are ready to pay for this company.
That's really interesting. So sustainability definitely now plays almost like a pivotal role into really how the companies are evaluated, right?
Absolutely, we see it as a key component of our value creation process.
Fantastic. Well, that's good news for sustainability. And there is $47 trillion, if I'm not mistaken, right now in pension funds. So this is a question for Tony. I mean, Tony, how can companies use their employees' money wisely to invest in ESG pensions funds? And also how they also beyond that, how they wisely invest their money into ESG. So over to you.
Great, thanks, Dan, and thanks for the invitation to speak today. So I think the thing to look at then, as a company thinks about its overall strategy on sustainability, what it also needs to do is think about the pension scheme that it offers its staff. So employees put money into their pension scheme, but also the company does as well. Sometimes the company puts in twice as much money as the employee. So both the employee and the company have a stake in that money. And the thing is, as that company is making efforts to become more sustainable, to tackle the ESG criteria that Lapo just covered, why aren't they also thinking about the money they're putting into the pension? So it's absolutely vital that we do. If we think about ESG, one of the most topical parts of it right now is the environment bit, is looking at the impact on the climate emergency. And we did some work with Aviva, a huge financial company, and we looked at the difference between an average fund that you might put your pension money in and a sustainable fund, and worked out the emissions, the difference between behaving normally and actually reducing emissions. And we compared that to actions an individual might take, becoming a vegetarian, stopping flying, switching their energy provider to a renewable energy provider. And the difference between an average pension and a sustainable one, the difference in emissions is 21 times those personal actions combined. It's so powerful. So the key is that companies and employees don't forget about where they're also putting their money. And then the action really is to try and get that money they're putting into their pension to align with their values and their actions on sustainability. So one element of that is for companies to ask their pension provider to align to net zero emissions. So you want your pension to rapidly start reducing emissions. As an asset owner, the pension fund has shares in lots of companies. It can be asking those companies to reduce their emissions, and that will help the pension fund reduce emissions as well. And in that way, take action on the environment bit of ESG, but the same can be true for some of the social factors and governance factors as well.
Thank you very much. Yeah, I mean, you said that I think the key action point for this is ask where your money is invested. And this is not about switching pensions, like you said, Tony, all the time. It's about perhaps encouraging the current providers to actually think about a different investment strategy. Is that correct?
That's absolutely right. So only a small portion of people actually switch their pension to something more sustainable. It's complicated. Most people don't understand money that well. So really we want to move the bulk of money, the 47 trillion, we need to move that in a way that's aligned with tackling climate change, that's aligned with decent working conditions in the companies that they invest in, all of those things. And I think people forget about their pension power. So trustees of pension schemes, they're not used to individuals writing to them, demanding something better, nor are they used to companies saying to them, well, look, you're providing our pension scheme. I'm not happy with what you're providing, and I want you to change. And if you don't change, we might switch provider. And then if you're a company with 300 employees or 400,000 employees, that's a lot of pressure on a pension fund, and they're going to start changing. And since we launched our campaign on net zero emissions, in the UK, we've seen 22 pension schemes commit to align their pensions to net zero. That's around £500 billion of assets. That's $650 billion that now will be aligned to net zero, 28 million pension pots. And what we want to see is that happening all across the world as people and companies engage with their pension scheme and demand better from it.
That is brilliant news. And that is definitely brilliant news for not just environment, but also the social side for ESG. And I mean, I guess this is the first time in history that the investment community has fully paid attention to sustainability. I mean, and Lapo, I'd like to kind of turn on to you because we have Mark Carney, ex-governor of the Bank of England, heading the COP26 coalition for finance. And what has happened, I guess, in the last, 18 months, is that there has been all these different frameworks of disclosure, transparency, and this pressure, this absolutely enormous pressure to actually standardize the way that we disclose. And this is not just for big companies, but also small companies need to start working towards a better way of disclosing their social, environmental, and governance impact. So can you explain, because you're much better than me explaining this, what is the difference between all these acronyms like SFDR, which is Sustainable Finance Disclosure Regulation, and the TCFD, which is the Task Force on Climate-Related Financial Disclosure? And how will this affect big and small companies going forward?
Sure. Well, the SFDR, as you said, the Sustainable Finance Disclosure Regulation. What is usually referred to as TCFD is actually the recommendations of the task force on climate-related financial disclosures. So clearly you can see from the definitions that they deal with financial disclosure, okay? Together, these regulations, they are, let's say, the blueprint of ESG disclosures for investment managers like us in the EU and the UK. Let's start from SFDR. SFDR is part of the European Commission's package of reforms relating to sustainable finance under the EU Action Plan on financing sustainable growth. What the SFDR aims to achieve is to harmonize disclosures by investment managers like us, financial advisors, and any other really financial institution. They want to harmonize the disclosure to investors on sustainability information. And the integration of these aspects that we just discussed when we talked about risks and opportunities linked to sustainability in investment decision making. So the process I described earlier and how we have integrated ESG in our investment process is now being mandated by legislation. Okay, it was on a voluntary basis before. It was pushed by the United Nations efforts on responsible investment. It's now finding its way into law in Europe. TCFD instead is not mandated by law. It's a set of recommendations, which means that they create some kind of voluntary but consistent climate-related financial disclosure, set of financial disclosures for businesses to provide to investors and all other participants of the financial market. So the main difference is the SFDR, first of all, it's a piece of legislation, and it has a broader focus on sustainability, which is across the spectrum of ESG. So it touches on environmental issues, on social issues, and governance issues. TCFD, its focus instead is much more limited. It's limited to climate change, okay, as it says in the name. So it only looks at climate-related risks and climate-related opportunities.
Thank you very much. And I mean, obviously, nowadays, there's absolutely no doubt on climate change. We are actually reading the papers every day, and from all the the tundra in Russia melting and releasing huge amount of methane currently, actually, as we speak. The floods in the UK 2 weeks ago, the floods that are coming our way on Saturday and Sunday. I mean, this is obviously affecting the prices of commodities, the prices of raw materials, the price of absolutely everything. So let me ask you one more question, Lapo. So do you think that climate change will affect the cost structure of businesses if they don't actually take this in account?
If you do it correctly, it does already. If you do it correct, if you cost things correctly, it already has an effect on the cost. The fact is, the mistake and what the legislator is trying to fix is that oftentimes these costs are not reflected because they're not considered in traditional accounting. That's why we need these regulations to make sure that all the costs that are related to your operations are reflected somehow, even if they're not measured they don't affect directly this year profits to shareholders. They still should find a way to be reflected in when you report on your operations. And that's exactly, this point is exactly at the heart of these regulations.
Thank you. So I'd like to move on to you, Tony. I mean, can you tell us about the TCFD and what will come into play next year in the UK?
Happily, but just, reflecting on Lapo's last comment.
Yes.
So it's the same for pension funds. If they don't manage climate risk effectively in the portfolio, then actually they won't get very good returns. They won't be saving well for pensioners in the future. So there's been an acceleration of awareness in companies, but also in investors about the risks around climate change and to do proper accounting. So you'll have seen, in the media that BP and Shell and other oil companies have lost huge billions and billions in value. And that's because they did their accounts properly for the first time. So what they did in terms of doing it properly is they factored in the value of their assets, given that demand for oil and gas will reduce in the future as people transition to net zero, that oil rigs being constructed now will rapidly lose value. So when they did that, those companies had less value after accounting properly for oil price in the future and so on. So this factoring in risk is a very dominant issue, and to do that well, you need the proper data. So TCFD is one effort to do that well. In the UK, that'll be required by law in October. So the G7 summit had a mix of good and bad in it, but one of the good things was that they collectively agreed to mandate TCFD in their countries, and that's really positive progress. And what we're seeing is that the TCFD now being followed by TNFD, the Task Force for Nature-Related Financial Disclosures. I think that work on impacts on nature will accelerate because TCFD has sort of shown the way. We see work that Mark Carney's been supporting with people like Generation Investment Management, Arabesque and others on temperature alignment of the portfolio. So the whole world is committed to reducing global warming or limiting it to 1.5 degrees by 2050. If you look at a pension fund now, most of them are contributing to 3 degrees of warming, even higher for some of them. So there's work done to have a temperature indicator for a pension fund. So it would be 3 degrees today. They commit to net zero. In a year, it might be 2.7 degrees. A year later, it might be 2.5 degrees as they reduce emissions in the portfolio and their contribution to climate warming. There's been really interesting work done by the IFRS on accounting for sustainability. So there's been a large project working with standards bodies across the world to look at how companies can account for impact, positive and negative. And what I hope from this, that we'll get to a place where companies have their financial accounts and then also their impact account. And that will allow investors, those disclosures on impact will allow investors to also understand the risks in a company when they invest in it. And so we'll get to a stage where we'll have very good data for investors on the risks of investing in different companies, but also if pension funds want to invest in solutions to climate problems or society's problems, then they'll also know which companies contribute most. And so then that can adjust their investment. And ultimately, I'm waving my phone, we'll see this on a phone. So, if you have a pension, you'll have that on your phone on an app, and it should show you the portfolios of companies you're invested in, the impacts of your money being invested in those companies, and allow you maybe to vote at an AGM of a company and vote on their climate transition plan, or vote on, whether they're treating workers well in the supply chain and whether the company plan to tackle that is good enough or not. Or even recently with Exxon, directors of the company were voted off and replaced with directors better skilled to help Exxon manage the climate transition. So ultimately, we need to get this in the hands of people whose money it is, individual pension savers, but also then those companies who offer workplace schemes, they'll start choosing pension providers who provide better data on the impact of their money.
Thank you, Tony. I mean, listening you speak, it makes me really crystallize and visualize a future, and a future which it have to be created in the next 10 years. Actually, forgive me, in the next 8 years, because we are almost 2 years down, so we only have 8 to go. So we need to hurry up. And I mean, what makes me absolutely red, boil my Latin blood, I would say, is the fact that companies still are actually actively greenwashing when there is actually an incentive, an economic incentive to not do that. So, Lapo, how does the world of finance approach greenwashing?
Well, it's a great concern in the world of finance because if you believe that ESG factors drive risks and opportunities, and if you adapt the price that you pay for an asset based on those information, then you're really interested in making sure that the information you rely upon to calculate how much you are willing to pay for this asset are correct. That's why we are extremely comforted, and we support fully the efforts by the European Union, which has passed into law SFDR and TCFD will be passed into law in the future. We have a fiduciary duty to our investors, and any legislation that can make it more certain for investors on which information to base our decisions, the best. So we welcome these changes, and we're happy to play our part in working with the companies we invest in, with the legislator, to enact and participate in these changes.
Thank you. I mean, and Tony, how do you see this in the world of pensions? Do you see also a greenwashing fest like we see it in the world of luxury?
I think if you look at most pension funds reports, they've got pictures of trees on the front. So, and there'll be a commentary about ESG and all of that. So, consumers, pension savers don't know the impact of their pension fund at all. So I think this work on, information for decision making that Lapo referred to, we need to standardize what that information looks like so everyone agrees that's the right kind of reporting, and then get pension funds to report on their impact, and that to a standard. So ESG becomes a standard, impact standards, and then people will actually understand if they're greenwashing or not. It gets very hard to greenwash when you've got to disclose all of this information. So I think that's really key. Clever businesses don't greenwash because actually they're going to make more money by being more sustainable. And if you look at ESG funds in the past 10 years, they're slightly better than the market, sometimes much better. But companies who are thinking about being around for the long term, you know, if you're sustainable, you know, you look at the resources you're using, you look at the risks around you, you look at the risks around treating your workers well or not treating them well, all of these things, you know, you're going to perform better in the longer term, and you'll make more money for yourselves and for your shareholders. And those are the companies that pension funds should be investing in, because they're investing so they can pay pensions in 40 years, 50 years, 60 years. You know, if you're 18 now, that pension fund's got to pay pensions for you when you're 65. So they've got a long-term view, and so we need to move quickly past greenwashing. But there's a lot going on. We need to make sure that pension savers and companies that choose schemes can have better information in order to make decisions.
Yeah, absolutely. I mean, at Positive Luxury, we have the butterfly mark, and our assessment is incredibly tough and incredibly rigorous. But the rewards of that is when you get on the other side of that, you have a future-proof business. That is, every 6 months, the assessment is updated with top-ups, and every 2 years, you need to be recertified. So, I mean, it's possible, and we can align with the world of finance. It's just the willingness of companies to really make that step change and that acceleration that we have seen, you know, kind of started to happen with the pandemic. But we really need to see that momentum keep going and accelerate it to 2030, really. So I'd like to ask you about COP again, Tony, because you are launching a charter around COP26, and also you are preparing with our team and launching a sustainable pension pledge around COP26 as well. So can you tell us a little bit more about the initiative?
So, you know, we're pleased to work with you on a Positive Luxury sustainable pensions pledge. And the idea, you know, this, we need to work this through, but the idea would be that companies would sign up to that pledge, and what they would commit themselves to do is to work with their pension fund, the provider, or the trustees of their scheme to explore how to align their staff scheme to net zero. And it's quite a gentle ask, but it shows an intent to get to net zero. And I think the more companies that you can get to sign up to that pledge, you'll be showing the power then of those companies in demanding better from the pensions industry. And that allows us to go into COP with more companies saying, look, we want better from the finance industry, better from our pensions. And that's what we're asking for and working towards. And then we'll get that broader momentum, because what we want to see really is all finance needs to be aligned to net zero. You know, it's finance that helps create the world around us, and it's important that we get it on the right track for building a world that we can retire into. So we're really, really pleased to be working with you guys on that.
Thank you, Tony. And I mean, Lapo, what does the world of finance expect from COP26?
Well, I agree with what Tony said. We were all in this together. We need to create a world that will be able to sustain our pensions, but sustain life as we know it. Sorry if I'm over dramatic, but the mission cannot be achieved just by one actor in the economy trying to tackle this. These challenges are not for just one actor. Even, you know, the United States government, the EU, cannot do it alone. That's why, as I think Tony said, the financial sector is key. It is key because we think the financial sector is basically the trade union that links all of the economy. And it's also one actor that can co-opt the collaboration of everyone else. So, in a nutshell, we think it's extremely important, and finance will be key.
Thank you very much. And I don't really know how we actually gone to half an hour talking together, but we need to go to Q&A. So if you haven't yet submit your question, please do it at the bottom of your screen on the right-hand side. I would like to start with you, Lapo. There is a question that says, how can you explain a bit more about the SFDR and the TCFD and how to differentiate them?
Okay. Well, the SFDR is a European regulation, so it applies to countries in the European Union. To countries, to investors, banks, insurance companies that are resident in the European Union. So it's a matter of scope. The TCFD is a UK initiative. I mean, it stems from global recommendations, but it's going to be passed into law in the UK. When we refer to this, we refer to a UK initiative. So that's the main difference. If you want to, there's more when it deals with disclosure, financial disclosure, as a first step to use the financial sector, as we said, as a tool to move the entire economy in a certain direction. So financial disclosure is one specific part, is our incorporation of ESG in the investment process goes beyond what we disclose at the moment of marketing financial instruments, which is what financial disclosure in the end means. We apply it also during the ownership phase. So not only when we communicate to our investors, but also in the daily life of managing the companies we buy, or managing the investments. So it's a first step. It's an important step, but it's a first step.
Yep. Every journey starts with the first step. There's a question, I don't know who would like to take this one. As a micro business looking for investments from an investor interested in ESG performance, where do I start? Many investors have been seen not to value sustainability as much as the business does. Where does somebody start? And hopefully this is going to change. So who would like to take this?
If you want, I can take a stab at it. So I think one way to look at it, and maybe it can be helpful in positioning yourself, it's sustainability is often seen as some kind of screening process, like, oh, you have sustainable businesses because you make solar panels, wind factories, wind farms, or anything else that is automatically considered like positive for the environment or for other things. But in reality, if we want to achieve net zero, if we want to achieve more ambitious goals, we cannot just select some business models and say, oh, those are good, and then the rest of the economy is left out. Everything that we do, unless we want to change our way of life, everything we want to do, steel, concrete, shipping, everything that we do has to be done a bit better. So sustainability, and what is important to communicate to investors, is that you're trying to do whatever you're trying to do in a more sustainable way, because you think that everything that we do in terms of company, any sector in the economy, has to move in that direction. And what we see is that often, there is this simplistic view of positive screening, like, oh, this is good, and then, the rest we don't invest in it. I think investors have to invest in all sorts of businesses, even if they work in a sector that is traditionally considered not particularly appealing from a sustainability point of view. Actually, the chances of making good, of doing good things are higher probably in a sector where things are done in a very, I'm talking about the environment again, but in a very polluting, for example, way, because you have a chance to reduce this impact. And so there is this idea. You have to communicate what you say in terms of incremental improvement in whatever sector you're chosen to operate in.
Thank you very much. And I must add here that the social factors are absolutely huge and important. And this year, I guess the spotlight is on the environment because we have COP and we have COP in the UK. But next year is definitely going to be the year of social. So we need to start looking at how we also have a positive impact on people, and that's not your immediate employees, but also within your suppliers and your value chain all the way throughout. So, and of course that also goes up to nature as well, like to Tony's point in terms of the charter for disclosing and accounting for nature in the future. There's a question here: what is the difference in value, if any, between a company that proactively chooses transparency and disclosure versus one forced to disclose by legislation? What advice would you give companies who fear transparency? I don't know who would like to take that.
I could have a little go, and maybe Lapo could touch on the value of the company. But I think, you know, and you can often see this, you know, if a company knows that it's got some issues within the company, it's difficult to start being quickly transparent. You know, you're exposed, there's reputational risk, all of these things. What I've liked when I've worked with B corporations and their diagnostic that they use to become a B corporation, lots of companies use their diagnostic privately, and they work with B Corps to sort of test the company against the diagnostic, see where they are, and it might take 2 or 3 years before they think they've tackled lots of issues, such that they then can go public with the diagnostic and the score. And I think maybe, Diana, I don't know well enough, but it might be the same with your butterfly mark, that a company can try out and test itself, see where there are gaps, and work towards tackling those, such that they then become transparent when they feel they've tackled some of the issues. I think the problem for a company that gets railroaded into being transparent because of legislation or regulation is suddenly going to find itself having to adapt the business very quickly and tackle things very quickly. And that's not very productive for the business. It's not an efficient way of operating. It takes time to plan these things and to manage the change. And if you're exposed to some serious problems that you've neglected to look at, you're going to run into problems. You know, people refer to it a little bit like a handbrake turn. You know, you're suddenly jolted, and that's not a great way to operate. So I think, you know, good companies look ahead, they see the trend and direction of demands on them, and they get ahead of the game. But if you put your head in the sand, someone's going to kick you up the butt. So, you know, I think being ahead of the game is good for your profits in the long term. But I don't know how it's valued, Lapo.
It's exactly like that, Tony. Eventually, if you know, investors are interested in transparency because, of course, reduces risk-adjusted returns, so increases risk-adjusted returns, and they are interested that the information is reliable. And in terms of value, what the difference that being forced by the regulator or doing it voluntarily changes is, one, the reliability of information. How do you calculate it if it's a last-minute effort to try to do it and get, you know, past the hurdle? Maybe you didn't, you know, do a thorough job. And the other thing is, if you are forced by the regulator, you didn't prepare in the past, chances are that this has affected your ordinary activity, and then the rest of the business will suffer, because we see it every time. Doing this disclosure is not easy. These are the data this is data that is not reflected in the ERP. It's not. It requires investments from the company. It requires specific projects to start tracking and monitoring KPIs in these matters. And if you do it last minute because there is a deadline from the regulator, chances are you are disrupting your operations to prevent, and then the value of the business will be affected. So completely agree. That's why it affects the valuation.
Thank you, Lapo. And actually answering to you, I mean, the difference, I guess, between B Corp, which is a brilliant framework, and us, is the fact that they actually have I don't know, zillions of companies across every single segment. And we very, very much focus on luxury, and that's across the luxury sector. So, you know, beauty, drinks, travel and hospitality, and so on. Therefore, we actually have a very, very good understanding of the impact and dependencies of the luxury industry, from raw materials, you know, the fact that, you know, travel, and those impact and dependencies, how they affect the business in the short and longer term. And this allows us to do materiality. And they're also not just materialities right here, right now. Lapo, you will love this. But also we are looking at how you can forecast materiality. So, and that is very valuable for the investment community. And that's why we update our framework every 6 months. So this doesn't affect the score to businesses, but actually they can actually see what's coming their way, so they can actually get better into refining and updating their strategy. So we are slightly different from them. We only have today, I say only, 200 brands, and they're more into certification. But the reality is that our process is exponentially rigorous, but the reward is exponentially better. So that's kind of just answering your question. And there's another question I'd like to answer that are asking on the chat, which is when are we going to see the pledge? And this is coming up in September. So look up in the website. And if you have not catch it on the website, please sign up to our newsletter and you will find it there. And I've got a last question. Maybe that's all the time that we have for, but this is a question, I don't know who would like to take it. How is sustainability defined? No one seems to really know that. I will do that one quickly. And then I always say that there is no sustainability without renewability. Natural capital should be the way to go, but can you get the returns needed to keep the economy going? So I'll give a go to the first part, and then I'll hand it to Lapo and to Tony. So there is actually one definition of sustainability coined by Harlem Brundtland, twice Prime Minister of Norway, and she coined the term sustainable development as meeting the needs of today without compromising future generations' needs. If you pause and reflect on this statement, it's so easy to really think about how to do sustainability well. Think about your actions and think about how this will impact the people coming behind you. And as simple as that, really. Open to Lapo and to Tony for the rest of the question, which is natural capital should be the way to go, but can you get the returns needed to keep the economy going?
For the returns to be there, I think you also need the laws to be there. I mean, it is true the returns would not be there without a certain framework of laws and regulations. So yeah, we cannot prescind from that. It has to be a part of that.
And maybe the other thing to add to that then is, you know, the challenge we've got right now to align to net zero, to limit warming to 1.5 degrees, it's huge. And in a sense, it's pathetic, because all we're trying to do is do no harm. And actually limiting warming to 1.5 degrees isn't going to be sufficient at all. We're seeing this today. You know, we used to say, oh, there's a heat wave, there's a flood. But actually we're seeing, you know, California burn, you know, British Columbia get to 50 degrees centigrade and people die. China, people on a tube train, you know, almost drowning. So these catastrophic impacts are happening now. So you're right on the sort of, David, on that renewability thing. We need to not just limit the damage, we have to start reversing it. And I think, as Lapo said, laws are key. You know, the pressure on finance to act better is important. But once, for instance, when you ban internal combustion engines, when you say, right, no more cars after 2030 with a petrol or diesel engine in it, you've changed the market completely. You've given different incentives to finance and to companies to behave better. So I think that natural capital, the need for carbon sinks, all of these things, that we're just, those things will develop rapidly. as we try and work out how not just to limit harm, but reverse it, and then for finance then to have a positive impact. But there's a lot of work needed, and a lot of laws and regulations will be required.
And thank you very much for saying that. And do you know what is the sad part? The sad part is that Paul Hawking wrote the book Natural Capital, I don't know, 20-something years ago. And some of my mentors and people that are on our board, like John Elkington and Jonathan Porritt, they're in their 70s and they've been working on this since, their 20s. So we knew this 80 years ago, and we're only racing to the last mile 10 years when we have almost completely, messed it up for future generations. So I really hope that we have the opportunity to actually pause and reverse. And I really hope that together we can achieve this with systemic change. So I just want to say thank you for taking the time and for your brain power and for your optimism in a not very optimistic topic. And I would like to hand the floor to Claudia. So thank you very much for all your time and your help. Over to Claudia. Thanks.
Yes, thank you for your time, Lapo. Thank you, Tony. Please head over to positiveluxury.com now to download your copy of our new report, and email us at hello@positiveluxury.com if you have any questions or feedback. We want to hear from you. We'll be back in September with a new series of webinars. Until then, take care and stay safe. Thank you. Bye.